Yo, fam, welcome back to our favorite day every month, the FOMC Fed meetings. We've got about half an hour, just half an hour, before the Fed will release the meetings notes. I'm just giving you a quick rundown. That'll happen at 2 p.m. It's currently 1:30. We're going to go through what these hikes are, why they're doing them, what we can expect, how long we can expect this to go on, etc. We're going to touch on quantitative easing, quantitative tightening, basically giving you a background of really why they're doing this or what their goal is, at least, in doing these things. So smash the likes and subscribes if you're here, fam. It's a chirp-pow day. We may have a Gina sighting. I hope so, at least. And at 2:30 we'll see the official live. We'll have it streamed here with some commentary. You see that up in the top left. So you have the schedule. There you go. Thanks for being here. We have a huge crowd. I scheduled this out early. I didn't know how that would go. It looks like it's going great. We got like 400 viewers. Rock and roll. Let's get 420 likes early. We can do it. I think today's 1,000 likes day. Appreciate you guys. Appreciate you being here. So we have a very interesting situation. We watch these here every month, and it's just a little bit of fun on what is usually a very boring topic. Interests, Fed actions, monetary policy, not really that exciting. We try to make it a little bit more fun, a little bit more digestible here, and break it down for you guys in easier to understand language. So what is up? We have Stream Ginnerty. Stream Ginnerty is taken by Mr. Charles Wood 52. Thank you for subscribing, brother. Great to have you. All right, so basically, we've had these meetings every month. They've really been kind of nothing burgers. We've had them for like the last 2 years. A lot of the time, the Fed says nothing. That's usually what we bet on, is that it'll be a lot of fluff, not a lot of concrete information. Today might be the exception. Today's going to be a little spicy. So the Fed has scheduled 50 BPS interest rates all year, every month. So far, we've seen them kept on track. It is currently June. So that's what, 7. They've been on track. I know they haven't done 7 of them. Anyway, moving on. I got a little mixed up. They've been on track, and that's kind of a nothing burger. Because they've set these out in advance, markets essentially bake this in. They front run it. They know this rate's coming, and so they adjust. And they essentially adjust to what the market would likely look like after the rate decision. So 50 BPS is scheduled. We have heard rumors and talks about 75 BPS. We've heard even as high as 100 BPS. That'd be pretty wild.
BPS.
Whoa. Hopefully I'm live. I hope we're live. We're live? Gina. Yep, someone said Gina, we're live. Where was I? The 50 is essentially baked in. The 75 at this point is a little bit of a wild card. This could be baked in as well. We've had some time, but I would say that a 75 BPS hike, which is currently winning on our poll, 51% of us with 500 votes, smash those poll votes, chat, get hype, like and subscribe. It all counts as engagement. Engagement encourages YouTube to push this stream to more eyes. It's going to be a spicy one, and so I appreciate everyone who's doing that. It does make a difference. It's not a placebo click. It literally does help the stream grow, so I appreciate you guys. 75, I think, is still going to be a bit of a wild card. I think we're likely to see the dollar reach up to that 106 or 108 on the Dixie, gaining more strength, really the more aggressive these BPS hikes get. So if we see even higher than 75, I think that the upside on the dollar is very likely. Unfortunately, this does directly spell for more sell-offs in markets across the board. We're not talking just crypto. This is outside the realm of crypto right now. This is bigger than crypto. This is everything. Weird that I would say bigger than crypto. This is all markets. It's very serious. If the Fed gets very, very hawkish, overly hawkish, which I am going to present the argument that I think they're going to. Maybe not today. I'm not going to present it as today, but in the months to come in this year, I fully believe that the Fed, and I still do stick by this, I think they're going to have to walk it back, because what I'm about to tell you and how I see this going down, I think is going to be too aggressive. I don't think, especially going into midterms, that the Fed is really going to be able to pull off what they have planned. It will be really devastating. We're already seeing the Nasdaq's down 32%. That's greater than the March 2020 crash. It has moved down a larger percent than in March 2020. What has happened on an economic scale? Not really that much, other than the Fed doing these rates. It's kind of interesting. It's almost like they're creating the problem that they're trying to solve. They are combating inflation. So the Fed is tasked with two things, and that's to manage monetary policy, and that's essentially to keep inflation under control. And that brings us to what we're doing today. In May, the CPI numbers are the official inflation released by the Fed, which is obviously massively underrepresented if you look at the numbers, but we're going to go on that anyway because that's what they're supposed to be adhering to. They're supposed to be. CPI is essentially inflation. They need to combat inflation to do their job. Their second job is to weirdly manage unemployment, and these two things are kind of contradicting and put the Fed in a weird position. The Fed can't really successfully manage both. Uninflation numbers right now are pretty typical. They're right about where they were before the March crash. I think it's like 3.7, 3.8%. Unemployment rate is a terrible metric. I'll just get my little jab out on unemployment. Terrible metric. It doesn't represent much. It represents recently unemployed people, not the total unemployed population. So I think it's kind of silly in general to look at it. But that, without unemployment coming up, the Fed is not going to or isn't supposed to get more dovish. More dovish meaning less aggressive. So they're in a weird spot. Inflation numbers are at a 20, 40-year high. The dollar's at a 20-year high. Inflation is up and the dollar's up. And so what they need to do to fulfill their task is they're going to need to raise interest rates in order to combat inflation. I don't know how they're going to make it through without tanking everything completely, but essentially, rates are CPI was at 8.6, I believe, for May. So historically, what we've seen is that inflation doesn't really start to get hit or doesn't really start to fix or trend in the right direction until interest rates reach about within 2% of inflation. Interest rates, I think, are currently, I may have to pull this up. I think they're currently at, ooh, that's not right. I think they're currently at, 1.5 to 1.75? I'm going to pull this up quick. For some reason, I don't know how to read this sheet. I just know that 10-year treasury yields are up, bonds, all kinds of weird market dynamics are in play. Let's pull this up here. I'm just going to pull this up quick. Where are you? 230. Whoa. Wow, this is embarrassing. Where? Today. 8, 9, 10. Oh, okay. It's over here. They're going to have it here? Nope. They're just going to have the last dates. Crap. Oh, no. He's choking. He's choking. Interest rate decision. Okay. It looks like, all right, 1%. I guess it was only at, what? April is at 1%. Yeah, I was right. 1.5, I think, to 1.57. So you can see the problem here. Interest rates are at 1%. CPI is at 8.6%, I believe. That's a 6% spread until what the Fed's doing, according to history, will start having an impact. Making a 0.5 BP or 50 BPS hike will get them there in what? 12 months, a year from now? That seems a little slow. I think that the Fed, I still believe they're going to walk it back. I keep saying that. But if they don't, if they follow through with what they're tasked to do and what they said they're going to do, they're either going to have to speed these up and make them larger hikes, which is why we may see this 75 BPS today. We may see even 100. We'll see. I think that might be a little too crazy for Powell, but you never know. You can get the idea here is they're very far away from these things making an impact. And the problem is that markets are already down crazy amounts. For them to continue for 12 months with these little BPS hikes, I don't think it's going to cut it. I think they're going to have to crank it up. If we use February next year as a timeline, I think that's when midterms are. That only gives us, what, 7 months, 6 months, 7 months, I guess, including this one. And that might imply that the Fed's going to have to look at 100 BPS rate hikes to get to near the CPI in time for, let's say, midterms as a kind of random place to choose. Yeah, that's good. The second issue that the Fed has is all of the quantitative easing that has been done. I think it was somewhere in the tune, I think the Fed balance sheet here is at 9 trillion. That's with a T, trillion. You can see actually that for the first time since 2019, it actually has come down a little bit, as I believe the Fed did start quantitative tightening. So quantitative easing and quantitative tightening are kind of monetary magical tricks, magic acts. The Fed essentially changes some numbers on a computer, purchases treasury assets and bonds, things like that, and in essence creates money. This can be great if that money goes to the right things like infrastructure, things that have a return greater than $1. They're actually adding value to the economy, and debt and printing money can be good. The problem is that when that money doesn't go to efficient uses, kind of like how we've seen maybe this $9 trillion go, it becomes just a drag on the economy. It's just dead money. Doesn't really even exist. Holy.
Tom Cruise Crown Fire Cool Full Score United States Purple Heart Love Ya Brother.
I love you, Joe.
The Steak on Buddy and Me United States Tears of Joy Guide Dog Purple Heart Party Popper Party Popper Party Popper Party Popper Party Popper Party Popper Party
Thanks, Joe.
Popper Party
In the middle of my serious monetary policy, and I love you, brother. Thank you for the 100, dude. Keep your money. Stop tipping me. Do a 10-cent super chat. I'll play it. I love you, Jerry. Hope you're doing well. Hope the dog's doing well. Where was I? Quantitative tightening and easing. So they've got themselves very bought up. They've begun maybe unloading, or they're going to have to unloading. And so what they're essentially going to do is they're going to be selling assets on the open market. I think you can see or put these dots together how this is a pretty dangerous situation. Interest rates moving up. We've already seen assets move down. And now the Fed is going to start not essentially market ordering, but market selling on the open market as much as $9 trillion worth of assets. Now, they're not going to do it at one time. They do have a schedule. I believe it's $45 billion a month, and they're looking to amp that up to $100 billion a month or something. But you can see this is really the same problem that interest rates have. Interest rates are so far away from the Fed from the CPI, from inflation numbers, that they have such a long way to go. The same thing is true with their balance sheet, with the quantitative easing, with this kind of money they've imagined out of nowhere. They can start selling it, but what does $50 billion a month do to a $9 trillion debt? And the answer is very little. At that rate, it will take them how many years to offload this sheet? I don't think they're actually going to offload the entire sheet. It's very unlikely that they reach a $0 balance sheet. But even to return to levels in 2019 or pre-March 2020, that's $6 trillion. That could take, I don't know, at $100 billion a month, that's $1 trillion every 10 months, 50 months of selling $100 billion worth of assets. They have themselves in a very tricky spot. I am very skeptical on what they're going to do. I don't know how they can increase rates and keep quantitative tightening on track and not have everyone go broke. It's going to be interesting. That's why today is going to be, in my opinion, one of the spiciest Powell meetings. And it's actually a very low bar because these meetings are generally very boring. But I think it's going to be the spiciest one. Bitcoin has traded down last night to 20,000 on the dot. I mean, in the last few days, it's been like, oh yeah, that's probably going to happen. But a year ago, I wouldn't have expected this. I'm still a little razzled from it. But here we are. Here we are at 20K. And we have Powell coming in to potentially drop some hawkish bombs on us. This is going to be spicy. Here's like maybe my silver lining for today, guys, is if the Fed follows through, that's going to be pretty bearish for markets everywhere. That's hard to cut any other way. However, Bitcoin has dropped from its high of nearly 70,000, 69,000, nice, to 20,000. That's a big drop. That is a large drop. You're talking about Nasdaq down 32%. Bitcoin at its previous all-time high down 70% from the high. Here's where my brain's at. The Fed can walk it back, and then I think everything goes up. I think everything goes back to all-time highs. Stocks, Bitcoin, crypto, whatever. Everything goes back up. Markets go back up. They take a big relief. That doesn't mean they go up forever, but they take at least a large relief rally as the threat of interest rate increases rolls back and people relax a little bit. Or they follow through, and we see markets dump. So where my brain is at is Bitcoin is down 70% from its high. Historically, in bear markets, we've seen 85% retracements. We're not that far. We're not that far away. We're about a 50% dump to 85%. Stocks, however, Stocks down, NASDAQ 32%, some indices are a little higher. My thoughts are crypto is likely closer to a bottom than stocks are. If we go down the route of the Fed being stubborn and not rolling back, not going back on what they've said, I think crypto is closer to the bottom than stocks are. I might be wrong. You guys know I love crypto. I might be biased, but I think that's a decent bet. That doesn't mean anyone should go all in today, put all their, mortgage your house. No. If we are in the scenario where the Fed is going on this course, this could be very long, as we just described. It would take, even at 100 BPS, it'll take almost a year to get to where they need to be. So that implies there might be a year of pain ahead. Quantitative easing is like 5 years out. They'd have to do way heavier tightening. They have to do way more intense tightening to get down that balance sheet in a significant manner. So what those things tell us is we either are going to see probably a violent rally if they walk it back, or until that happens, or if it doesn't happen, we're likely to see markets continue to sell. So how much farther down can crypto go? For altcoins, for random projects, low caps, who knows? For Bitcoin, I think it's unlikely. It's unlikely to see it trade more than 85% down. I'm not even sold that's going to happen. So let's go through our Bitcoin kind of major points here. This yellow MA, this is the 200 weekly moving average that we closed below yesterday. We closed below it for the first time yesterday. Before that was in March of 2020, all the way back here. Boom. Historically, this has been maybe not the bottom, but it has been a strong point of entry in Bitcoin's history. To see, it seems like people are very confident in the 200 weekly. It's just a moving average. So people, the more confident we are this is going to hold, I think the more likely it is the weekly closes below it. I think that really would cause panic, because people will be like, oh, this has really never happened and this is bad. It's just a moving average. If we close below it, that's not bullish, but it's really not the end of anything. These major support levels below us, I think, are much more important factors. Those are, as we've discussed, as in the short pin to the top of the chat here, we've got 20K, we've got 17.1 as the January 1st or 2008's high. 13.8, it's a very important monthly support that was never back tested on the way back up. 10,500, which would be the exact point of that 85% retracement from the high. And then the numbers below are all too familiar. We have, let's say, 6,000 and 3,000. I don't think that these are in play. It would take a very, very spicy situation, in my opinion, to see Bitcoin trade back to those. 10,500, I think that's probably the end of the line if we do see selling continue. 13.8, pretty reasonable, pretty logical target. But none of these are really guaranteed. We could still see the 200 be respected. That is basically right now the 20 or the previous all-time high has been back tested. That counts as close enough. Catching the bottom is a very difficult thing to do, and I wouldn't say is harder, maybe harder than catching a top. The best way, in my opinion, to approach it is the DCA style. That goes for everything. That's not specific to crypto. Small buys on a regular basis. Nothing that impacts your quality of life or your ability to eat or pay bills or leisure. Just excess money. I know that that's likely very tight right now for everyone, but it doesn't have to be a lot. We talked about this in the last few days. This is potentially the greatest opportunity for the millennial generation I'm part of that we've ever seen as adults. So we've ever seen with our own income that was significant enough that we'd be able to really do anything with it. If we do see the long, painful route over the next whatever, DCA, you may come out of this event very well off. It's going to be tempting to stop your DCA program or DCA schedule. When numbers go down, it gets scary. But stopping is honestly the least logical investment move you could make. Now, this isn't about crypto, it's about everything. Your 401k, your Roth IRA. Bear markets are where fortunes are born, and bull markets is basically where they go to die. It's terrible to say that, but it's very true. I know that numbers go down, people get scared, and you're like, I want this money, I need this capital. Never do anything that compromises your cash flow. You need to be able to cover bills and food. Never overextend. But if you can still invest in these things slowly over time, by the time the bear market's over, and no one knows when that can be. That could be, like we said, end of the year. It could be 5 years from now. We don't know. But when it does end, you will be so well off. You will have bought assets at their low. You won't have sniped the bottom perfectly, but you'll have accumulated them 20, 30, 40, 50% below their previous high. When they return to those highs, you're already up 2x. If you stop contributions, the bear market ends, it goes back to its highs, you're now just where you left it, but now how much time has passed? You're getting eaten by inflation, you're getting eaten by, I don't know, opportunity costs, etc. Very much encourage people to look at the silver lining here. This could be a once-in-a-lifetime event for us. As millennials, we really haven't gotten the good end of anything, and this may be our little gift. It's packaged in blood. But we may not see an opportunity like this or what is coming. We may not see it again. So let's check our emotions at the door today. We can take a look at some charts, but we've got 8 minutes. 8 minutes until the Fed notes are released. In 8 minutes, guys, we crowdsourced this. We got 1,500 viewing. Right on. Let's get some more likes. We already blasted through 420. Let's get to 690. Let's get to 1,000. We could do that right now. If everyone in here smashed the like button that hasn't smashed it yet, we'd get to 1,000 right now. I believe in you. If we get to 1,000, I'll be very happy. But the more people who smash the like, the more viewers see this. And that is even showing right now. We have 500 likes, and we have 1,500 watching. That's because you guys smashed those likes. It's only been 20 minutes, so we almost got 600 likes. That's because you guys are engaging in the stream. You're liking, you're subscribing, you're voting in the polls. I appreciate you. I'm going to pop up the chat here because we've got, not even 8 minutes. I'm going to pop up the chat, see how you guys are doing. What's up, Crypto Pup, Chic, Kasaba? Smash the like button, thank you. Joe89, thank you, sir. Denim, Isaiah, Eric, Crypto the Only, Zingdagi Photo. Good to see you back, my friend. Sean, what's up, Sean? How you doing? It takes a split second and it's free. It is free. If you're here, say something in the chat. Just say hello. I'll try to shout you out. There's a lot of you. Deezer, Tim Allen, Ryan, saw you earlier. Stillix, Elio, Mike Waters, TJ from Reno, me, Johnny C. What's up, Johnny C? Deucin. Man, there's so many. TV, Crypto, Matt, Keith, Big Tuna, B. Wow. Right on. I'm glad you guys are as hyped as I am. Hell yeah. Hell yeah. This is that's probably the biggest response I've ever gotten to make some noise. You guys rock. What's up, Rico? MILF Buster, Willie S, Jan, Anonymous, Deezer. Oh, wait, I saw a name. Dino Mike, man. How have you been, Dino? It's good to see you, dude. It's been a bit. Our Golem, how you doing, my brother? It's good to see you. Hope you're doing well. What's up, Jeff? Tezos. That's an old name. An old name, but a good name. Hype from England. Right on, everybody. Bing bong. 2 words. Gina. I can't wait for Gina, my beautiful Gina. I miss her. It's been a while. What's up from ATX? What's up, Maro Morel? Dave, Crypto Crabman. What a good name. Crypto Cyclops. I am Crypto Cyclops. Lewis Christie. Dr. Homo erectus from Croatia. First time on the stream. What's up, Lee Cable? This is a hype day, man. We're
Thanks for the stream.
Thanks for being here, Joe89, and I appreciate the 14 Canadian dollars. I will put them to good use. This is a little different of a stream. We do these once a month when Powell speaks, and today's the hype one, and we're showing up in force. So it's good to see the energy. Good to see the energy. Someone said, hello, Mitch Ray. I'm not Mitch Ray. Is Mitch Ray here? If he's here, what's up, Mitch Ray? But I'm not Mitch Ray. Oh, wow, there is a Mitch Ray. I wonder if that's the real Mitch Ray, though. Or if it's just someone who took Mitch Ray's name. If that's a real Mitch Ray, I should give you a wrench so people know you're not a scammer. It's almost time. We have 4 minutes. Here's what everyone needs to do. Open up your Google tabs. Open them up. Decision. Open up your Google tabs. This is the one I'm going to do. I typed in Fed interest rate hike decision. Everyone pull up a tab. Get ready. Because we're going to need all 1,500 of us to do this. So what we're going to do is at 2 p.m. We have like less than 4 minutes now. We're all going to search the web. We're going to scour the web as an army. And we're going to find this rate. Because it will be released to random, I don't know where, random sources, probably like news sources. They release the notes to these places at 2. And so we'll be the first ones to find it. We'll see who publishes first. And at 2:30, it's the official speech where we'll listen to Powell. We'll have it live here. And maybe I'll see my beautiful Gina. I'm sure Powell will not let us down today. But we're going to get ready, and as soon as 2 o'clock hits, we're just going to keep refreshing, and we're going to keep searching, and we're going to get that decision. Our poll is looking good with almost 1,700 votes. We're pretty one-sided. 75 BPS has held 51% of our vote. 26% in number 2 for 50 BPS, which is the scheduled rate hike. It's probably a good fallback. We got 22% of us looking for 100 BPS or over. If you were here in the beginning, I went through a lot of why they do these rates, what they mean, the importance of them, and kind of what we might expect if the Fed does do what it's supposed to do, how long that might take, and what that might mean for these increases. And 100 BPS or over logically fits into the timeline. I don't know if that's today, but I think I can say if we do 75 today, next month 100 probably in sights. Probably very realistic. Very realistic. Benjamin, hello. Powell announces his retirement someday. Probably after all this happens. Fake out before the breakout. Something moving? Something moving? Are we going? Let's take a look quick. Guys, have your Google tabs up, though. We need to find this. That's a little green candle. We're going to be watching Bitcoin and the dollar as we do every time during these live streams. We're going to move them down to a very low time frame. Dollar bleeding off smoothly. Perhaps what we've seen over the last few days, this pretty gigantic rally, perhaps already baking in 50, 75 BPS, and to see a little blood, likely sideways, kind of maybe slow bleed unless the Fed mixes it up. Oh, it is the real Mitch. Wait, Mitch is in bed? What's up, Mitch? Mitch Ray. Dude, guys, we have a little bit of time. We got 2 minutes. I'll just shout this out. Mitch Ray, part of my inspiration for starting to stream, for sure. Dude's been doing live streams on technical analysis every day for I have no idea how many years. Great analyst. Respect him highly. I just gave him a wrench. Go follow him. He's a good guy. Good dude. It came out 0.69. That would be hilarious, though. If he comes out and he's like, I know you've all been expecting 50 or 75, and the Fed has decided on a 69 nice BPS. That would be hilarious. Just troll everybody. And then Elon Musk jumps out from behind the curtains and he's like, I've been Powell the whole time. That's like a non-zero chance of happening, realistically. It has a non-zero chance. The 200 weekly sitting above us at 22,350. Bitcoin kind of ranging here into the notes. Wait, I got to keep an eye on the time. I'm going to talk through it if I don't. It is 1:58:55. We have 60 seconds to start Googling. 59 seconds now. You don't have to do it yet. Wait for 2 p.m. to roll over. Usually we can find them within 30 seconds, I want to say. I'm going to have the chat pulled up. I'm going to try to Google it myself. We'll see what's good. I'm shaking with anticipation, man. I'm shaking. Don't talk through it. Well, we got half an hour. Don't worry. This is where we Google. What do we Google? At 2 p.m. they release the notes. So Google any phrasing that you would. I'm doing this. Fed interest rate hike decision. Google some other phrasing maybe, or you can do this one too. And at 2, they will be released. So we'll get them right away. We do this every month, and we get them like within 60 seconds because we have so many people. We got so many people's. All right, 15 seconds, guys. 15. What's up, Albert Einstein? I haven't seen you in a while, man. Whew, I'm shaking. I'm shaking, bro. 5 seconds. 5 seconds. Ready? Start your engines. Open your tabs. We need everyone's help. First one. There it is. 2 p. Wait, is that 2 p.m.? There it is. 2 p.m. First one to get it, put it in chat. Also, you can do tools anytime, past hour. And don't report anything that wasn't published after 2 p.m. because it's just speculation. Let's do like Fed hike decision 25 minutes ago, 6 minutes ago, getting closer. 75, bro, that's what they're saying, but I want to see an article published after 2 p.m. that says 75. Wall Street Journal 75. Let's do Wall Street Journal. Fed interest rate hike. 7 minutes ago. That's 7 minutes ago. That doesn't count. It has to be after 2 p.m. It has to be in the last minute. Has to be in the last minute. Guys, keep Googling. Someone get it. Say what the Bloomberg TV, say what the interest rate decision is and where you got it from. Bloomberg Fed interest rate 75 BPS. I'm not seeing anything from past 2 though. 5 minutes ago, getting close. It needs to be like in the last 2 minutes. Let's see if markets are reacting at all yet. Bitcoin getting volatile into this. I'm thinking 75 is likely it. Boom, we got some volatility, boys. We're seeing CNBC reporting 75, Bloomberg 75, 50 on Bloomberg Terminal. Look on Twitter. Yeah, that is where I go to get a lot of my news. I'm not going to lie. Let's see. Let me refresh Twitter. Follow me on Twitter if you're not. Federal Reserve raises rates by 75 BPS. That'll be the largest hike since 1994. All right. Let's pull that up. Bitcoin Magazine, I trust them enough. They posted it after 2 p.m. I think 75 BPS is it. I think it's done. Done deal. 51% of us were correct. Well done, fam. Well done. We have good predictions. Follow me on Twitter. There's my Twitter's here. Yeah, there you go. I shit post a lot, but I do post some good stuff as well. I think we're going to say 75 BPS is the winner. This is not updating. Useless. Maybe Federal Reserve. There it is. Raises rates by 75 BPS. So here's the deal. It's 75. It is 25 BPS higher than the scheduled rate. We literally were talking about how I don't think 50 is going to be enough. It's not going to be enough going forward. They're going to have to inch towards 100 BPS to ever get close to CPI. I mean, unless CPI comes down, let's say June numbers are down, maybe we're a little closer, but I don't think that realistically they're going to be down enough for it to really matter. Raised its benchmark rate from 1.5 to 1.25. Wait, what? I thought they were already at that. No, well, I don't know. Who cares? They're farther away than I expected. Actual 1.75 forecast. Wait. Oh, that's just talking about the BPS. Never mind. That doesn't say the actual rate. Cool. So that was a little bit higher as we kind of speculated. The dollar here down on the 10-minute chart. Put it on the 1. Put it on the 5. Dollar did a little dip into this. Now finding some strength. That's a nice little kicker candle on a low time frame. Let's see the volume. It's not going to generate. Who cares? Bitcoin. It's funny how Bitcoin always gets volatile. We get these high, like swing high and swing low wicks during these meetings. So we've got 27 minutes till it starts. And Chirpow and my beautiful Gina will bask in their knowledge. We're going to watch that live here, so stay tuned. Smash the likes, pull up a chair, grab a beer, roll one, whatever you want to do. We got 420. Roll one if you want. We are 160 likes away from 1,000 with 2,000 viewers. Boys and girls, this might be our most hyped stream since last year. This is the largest hype 2020 stream. Wow. I had a feeling it would get spicy. I had a feeling. And I love sharing it with all of you. That's awesome. Short or long, I say this every month. During these meetings, I do not advise to take any position. That being said, 75 BPS, not quite as hawkish as I even thought could be done. I thought 100 might be on the table. That's not a bullish thing for markets. They may have baked in most of that, but unlikely they've totally baked it in, as they only had a few days. There really were only a few days that 75 rumor was in play, or maybe it was a leaked source. I don't know. Let's look at BTC. Let's look at stocks as well. Just check out in general what kind of day they're having. Just got an alert. Alert on Dixie. Is dollar breaking out? No time to look at stocks. Boom! Boom, baby. Kicker candle playing out. Got that nice green. We have a higher high for the day. Let's look at that daily. Whew. After hitting major resistance at 103.82, historical 20-year something resistance, saw a little fake break, and then the dollar painted a descending wedge here. We identified this very early. Hit a little descending wedge at 100.3. We said dollar's going to look to trend back up to that resistance. If it can close above, which it did last Friday, we're going to be aiming higher. 108.65, that's, I think, the 40-year high. We can zoom out to see that. The dollar putting in a new high here today, it seems, and 106, 108, something like that, looking on the table. Yep, 105.66. We've broken that high. We have another high for the dollar. Let's look down up to the weekly. There we go. There we go. We might be... Is Mitch Ray still here? Mitch Ray, is this a dragon pattern? Do you see a huge dragon pattern playing out here? Or am I smoking too much of that 420? I can see a potential, like, massive dragon pattern that, if it does fully play out, would suggest that we may actually see... What? 2000s? Dixie high broken? I don't know. I think if the Fed goes down the long path, that's possible. But... Dang, imagine the dollar trading up to like 122, up to like maybe 130. That would be very brutal, man. All investments would be in trouble. And also maybe other countries in trouble. If the Dixie goes to 120, I'm going traveling. I'm going, I don't know, Europe, something. Everything will be at like a 30% discount. It'll be cheaper than living here. Do I have a Discord? Yes, we have a Discord. Links in the chat and the video description below. I also forgot, shout out to our sponsors. Links at the top of the video, in the chat, and in the video description below. This channel is brought to you by Femex and Market Cypher, two of the cryptocurrency industry leaders for trading tools and exchanges. Femex is a little smaller. I've used them for years, long before they sponsored us. They have spot markets. They have leverage. They have an earn program. Kind of like Celsius, but not like Celsius. They actually loan the assets out on their platform. They're not dabbling in DeFi to get those returns. So check them out. Use my links. It helps support the channel. Makes me look good. I appreciate you guys. Doesn't cost you anything. You can get up to $4,100 deposit bonus on Femex if you use my link. And Market Cypher, if you use promo code CROWN, you'll get up to 15% off. So chills out of the way. Discord links, all those links in the chat. Don't forget to keep smashing those likes and subscribes. I think I need to shout out some more people. What's up, Alex Ballas, Matt Ferrente, Jose Larcico, Asian Batman. That's a good Batman, dude. That's a good Batman. Hell yeah, Kimball's Barbecue. I like that name. STXXLO, Health Nut Bob Malik, Bob Sanders, and Mohammed Elias Mossad. Welcome, fam. Great to have you. Make sure you jump in our Discord. We do a live airdrop after the stream. So all you have to do is be in there and verify. We're going to get back into the TA a little bit here. We have 20 minutes till the speech goes live, so don't go anywhere. We're going to make that screen at the top bigger. We're going to listen in, do a little commentary. I try not to talk too much, but I try to be entertaining in the background. Looking forward to hearing from Gina. She hasn't been returning my calls. Gina, maybe it's because she's married to a woman. I don't know. But Gina, if you're listening, call me. I love you. You're beautiful and intelligent. You're my perfect lady. Minus the whole, you're married to a woman thing. But I can look past that. Let's look at Bitcoin. Bitcoin actually not breaking its low here. I wonder why I didn't get an alert. Not breaking its low yet while the dollar is flexing on markets. Wow, traded up to 105.8. 105.8. Let's take a look at Market Cypher. Okay, money flows up, VWAP's up on the hour. On the 2 hour, looking pretty good, actually. Quick trip to negative momentum. Bought back up, higher VWAP high. Gonna be looking for that momentum to pull up, to break that money flow high, and then the dollar is off to the races again. 4 hour looking pretty bullish, wow. Holding its swing low here, refusing to give up ground. That's on the 4 hour, pretty spicy. 6 hour is, I'm jealously bullish. I'm jealously bullish of this dollar 6 hour. Oh my God. VWAP is pulling up. Money flow at a new high. Momentum pinching off of a higher high. Respecting its low. Dollar looks to gun it. Wow. Here's my prediction. If Powell talks about more hawkish hikes in the next months to come, which is really the only option. I don't see them remaining steady. It's either get more hawkish, move into this 100 BPS plus, or walk it back and say, we're going to cripple this economy and we can't do this. I don't know what we're going to do. Maybe we're going to go back to quantitative easing. The super hyperinflation route. One of the two. But if they don't go that route, they're going to go into more hawkish rate hikes. I expect this dollar to start ripping again. VWAP's down towards zero. Money flow is trending down. Momentum's pinching, but that may be undone by the end of the day, especially off of a comment from Powell. If Powell's like, we're going to have to get more hawkish, this dollar is going to start baking in the more hawkish route, and that 108 is looking locked and loaded. Wow, what a crazy time. Hip Hopo Apototamus. What's up, my dude? Sony, Kryptonian. Good to have you guys. S&P 500. Always good to look at stocks, too. Let's see. Closed yesterday. Crap. It hasn't really moved today. Weird. Hasn't really moved. Kind of back, maybe filling its gap from yesterday's, or from today's open. Not a ton of movement. I'm going to put an alert here. I don't have high hopes to see this break out. I don't have high hopes. I'm going to put an alert. What do we got support at? 3,500 below, another 200 points down. 6%. That looks right. I'm going to add this as SP 500. Hit. It's called a major support. That'll do. NASDAQ. How are you doing, NASDAQ? We're coming up less than 20 minutes till Chirpow. So don't go anywhere. Stay here. Keep hypes. NASDAQ weirdly kind of up. In a red candle, but higher, trading higher than it did yesterday. Aren't stocks great, guys? You can have a red daily candle, but it can be trading higher than the day before. You can have a green daily candle, and it can be trading lower than the day before. Just another one of those little things, you know, the little things where you see that stocks are kind of just gibberish. They're just gibberish. Like, what are they? What are they, man? GME, that's the only lesson you needed to know that stocks are gibberish. NASDAQ fighting to move back up on our low time frame, but does it have the power to fight through that dollar? I'm not sure, man. On the 2-hour, nice little potential bottom on momentum. 4-hour reflecting it as well. 6-hour, as we get into these longer ones, looking uglier. Wow, 12-hour, brutal for NASDAQ. Lower swing high in momentum, lower swing low on VWAP. Momentum's pooling down, and money flow. The most important, in my opinion, money flow right here broke its lows. Bottom does not seem to be in for NASDAQ. Does not seem to be in, man. If we saw some kind of relief, maybe you come back up to fill these gaps. Maybe you don't make it to the second gap. 10,500. It's funny how close that is to Bitcoin's major support level, isn't it? It's the same, pretty much the same number. Coincidence? I don't know. NASDAQ looking like crap, though. Maybe the day has a little more spice. Probably not. Same thing. Same thing as the 12-hour. We have a lower low in money flow. It's almost the same reading. Almost the exact same reading. I won't talk about this too long. All I'm going to say is Litecoin versus Bitcoin value. It's too early to get excited. I don't know, man. If a crypto bear market means Litecoin continues up against BTC, I won't be that sad. Up off its low against Bitcoin, 25%. This has happened before, but honestly, in the fashion that it's done it, we haven't seen this in a long time. This is like a V-shaped bottom on the daily. You can see that isn't really what we saw before in any of these. This is a very rounded bottom. This is more rounded, but it began recovering, then came up. This V-shape, no guarantee, but could be spelling capitulation for the LTC-BTC pair as it trends back up, even though price is moving down. Just a spicy take. We'll talk about it more in the future. Talk about it more in the future if it continues to hold true. LTC rip, exactly. The crown prince of Crapto. Got me, Glyph. Or is Litecoin the crown prince of Crapto? Probably. I'd make a great baseball announcer. Well, maybe I have a future there. I mean, if they keep with these interest hikes, man, I might go job hunting. We'll see. No, I'm just kidding. How you doing, Alchemist? You regrets not selling more in February? I think we all feel that way. You like round bottoms? Giggity. Giggity, giggity. BTC close to doing something it's never done. Drop below the previous bull market peak. It's interesting to me, guys. You know what? That's going to be a good filler. We got 15 minutes. Don't go anywhere. But this will be a good, interesting filler. So Bitcoin is close to doing something it's never done before. This is a sentiment that I see echoed a lot. And honestly, it's a sentiment that I myself may have said at some point. Well, I guess not unfortunately. Maybe fortunately. Let's say fortunately. Fortunately, well, it's a double fortunately. One, it's not true. And two, Bitcoin does tend to do things it's never done before. It's called the first time. And it tends to do them a lot. I've given up completely on Bitcoin has never done this, so it won't happen, because it seems every time we say that, it happens. If you look at the Coinbase or pretty much any exchange, that's true. So Bitcoin on the major exchanges right now has never traded below its previous all-time high. But in the history of Bitcoin, it actually has. Right here. You can argue and say 260 wasn't an all-time high. I mean, like, it was, but I can get what you're saying. Is like, maybe you can argue that's not a cycle top. But I don't know. You hit it in 2013 in April at 263. You fell 75%. Is it 75%? I thought it was more than that. That's why I want to get this tool out. 76%. You fell 76%, and then you went to a new high. I don't know. At the moment, we're at about a 69% retracement. Ha, nice. 69. And you can see that it did go on to make extreme gains back to up to 1100. And then it did fall back, though, below $268. So if Bitcoin falls below 20K, no, it's not exactly the first time. It will be the first time that, say, Coinbase or Binance have seen it. And I think that does have significance. But it isn't quite the spooky, fuddy kind of statement that a lot of people are saying lately. It's never happened. I mean, it has. It just depends how you look at the cycles, what you consider a cycle high. This one is really the one-off example. Now, does price action... Here's like kind of my weird probing question is, does price action really look like anything we've ever seen? And in my opinion, the answer is no. Look at these tops. Look at these highs. No matter which highs you identify as cycle peaks, look at these. They're very V-shaped. They're very blow-off top-ish. I mean, even 2019 without a new all-time high, very less V-shaped, but still V-shaped. Blow-off top-ish. What does this look like? Nothing. It doesn't look like anything. It looks unlike any Bitcoin price history that we've ever seen. That's my opinion. We had a high, a swing low, a higher high. Then the swing low kind of respected, arguably a lower high, but I don't think really lower high, but we could say it. And then we broke the low. None of that's really ever happened. None of it. We're in pretty uncharted territory. Pretty uncharted. I did have something I haven't brought up in a while. I think we have enough time to sneak it in. We haven't looked at this in quite some time. I got 10 minutes. We got 10. Where are you? So something interesting that we used to look at a lot, but we don't really look at anymore, is how the previous bull market moved, let's say. We saw these really big run-ups. They kind of traded sideways, because I'm making the argument here that maybe the price action isn't something we've not seen before. It's just over a longer time. This is on the weekly. You saw these run-ups, sideways trading, and then we saw essentially a capitulation sell-off. So we did see, in a way, kind of that high, a low in. I wouldn't say that we broke the high, we didn't break, but this is still more similar price action. Then we broke the low. So what does that make? It kind of makes like a symmetrical flag that breaks to the downside and then rallies up. And the reason I point this out is this is like pretty much what we saw all the way up, right? These are a little more janky, but that's what we saw on the way up. They look a little different, but we saw it happen over and over again. We saw a high, traded sideways, fell, wicked, got bought up, and then ran. So some of these are a little different, not quite as clean, but there's many good examples. And then if we look here, we can maybe say, well, this actually kind of does look similar. It's just much bigger. This is going to be on like a monthly time frame, not a weekly. Yeah, that's a good example. This could be. I'm not going to say the bottom's in. Catching knives is dangerous game. But we do have not that long actually in this quarter. Maybe it'll be like next quarter. Could happen this quarter. Countdown to bar close. 15 days to close Q2 here. Q3? Here's all we would need. And this seems far away now. This seems unlikely. But let's put our TA hats on and count possibilities. If next quarter we see price trade back up above this quarter's open at 45, all of a sudden we have a really familiar pattern. This is a little hopium. We're going to need a little hopium today because it's going to It's likely to get much more bloody in markets as Powell speaks, especially if he throws us a curveball. But you can start to see that that might be similar. Now, that is hinging on a lot. This does not look very likely right now. It's hinging on that the next quarter retraces all of this quarter's losses. That's certainly not impossible. But it is a lot to ask for right now, especially with how sentiment is. But if that happens, all of a sudden we go from this is completely new price action, we've never seen anything like it, to, okay, it really just kind of fits what we've seen. It's really just similar to these little wedges here, where we had highs, we had highs, they traded sideways, they broke down, then they got bought up and we went to a new high. Just something to put in your bowl today. A little copium to put in that bowl. Because yes, more dumpage does seem ahead. It does. We'll find out. It's going to be interesting. For those of you just joining us, you can go back to the beginning of this video. I wouldn't recommend it now, though, because we have just 5 minutes till Powell speaks. But we went through the interest rate hikes, why they do them, what their goal is, and what is likely to happen if they are to meet their goal. And that does entail more aggressive, more hawkish quantitative tightening and interest rate hikes. But today we already have the answer. It's 75 BPS, 25 more than the scheduled hike. So that's still hawkish. But what we're kind of contemplating here is Powell can come out, or he's going to come out today and talk about this, and the language he uses and how he describes the rest of this year going are going to be potentially bigger players than the price action we see just right now, in between the publish of the notes and the actual live. The reason being is they need to make this a lot more aggressive to really put a dent in the problem. So if Powell comes out today and says, we are going to go ahead and we're going to do 100 BPS next month, you are going to see a huge response from markets. If he all but guarantees next month is going to be an even more hawkish rate increase and maybe even bumps up tight quantitative easing, we're going to see a response, and that response is going to be way more important than just this immediate price action. In theory, 100 BPS for the rest of this year every month is probably not enough. So it may be even more hawkish. It's very weird. There's not many months until midterms. Midterms, historically, we have seen monetary policy be a little more agreeable, a little more friendly, a little more bullish for everyone. But we don't know. That doesn't fit what they need. It doesn't fit what needs to be done here to do their job. Who's selling at these levels? I don't know, Finesse, somebody. We need Gina. That's right, Marius. What's up, Crypto Stevo? Litecoin to the moon? Dude, have a wrench, bro. U.S. tax revenue has a 1-to-1 correlation to the stock market right now. I've never seen that data. I don't doubt it. If the market falls, the government will collapse. So that's kind of the other side of the sword here that I've been talking about. Is we went through and we're kind of bearish, we're kind of hawkish, because what they need to do implies much larger rate hikes, much larger quantitative tightening per sells, whatever. If they follow that, stocks are going to be brutalized. Major indices are already down 32%, greater than March 2020. If they continue this out, it will take time, unless they decide to do it all at once, which would be wild. I never thought of that outcome. Just we're gonna do 1,000 BPS hike, boom, and then just roll it back. I don't know. The problem is that stocks are already so low with no signs of recovery into these meetings getting more hawkish. I mean, how much weight can you put on something till it breaks? How much can you bend something until it breaks? The whole U.S. economy collapsing is not really an option. I mean, it's totally a real outcome, but it's not really something that anyone aims for, no matter really what's at stake, because at the end of the day, that's what they're protecting. They're protecting U.S. assets. If those all collapse, what are they protecting now? The dollar? I don't know. The government... All right, so indices collapse, stocks collapse. Yeah, tax revenue goes down. The government gets squeezed too. This is, as we've been saying for months, the Fed is backed into a corner. They're backed into a corner. They had a decade to raise rates. They didn't. COVID hit. Things were already on thin ice. That ice broke, and now they're forced to take action. But these actions are also backing them into a corner. The problem is this corner doesn't give them a route where they fix the problem. They can band-aid the dollar or they can band-aid stocks, neither of which really gets solved. I mean, maybe band-aiding the dollar like over many, many years, you can kind of, you still can't really solve it. But you can make it a little better. Neither course of action fixes it. And it's almost hard to imagine a far-out future where one of these two doesn't just completely implode. That's really the outcome, is one of the two or both implode. That's not today. Don't freak out. That could be 5 years down the line. It could be 10 years down the line. This is not today. This is the course that we've been put on, and the decisions to kick the can down the road for a decade or 2 decades, that's what's got us in this corner. The thing about roads is you can always build more roads, so they may find ways to kick the can down farther, but at some point you're out of road. We could be out of road. We won't know. That's kind of the scary part, is we won't know when they're out of road. They won't tell us. They'll tell us everything's fine. Remember, inflation was transitory. Interest rates, what else is transitory? All these they keep saying things are temporary and then walking it back. That's why we don't really trust anything they say. Pretty much the opposite of whatever they say we're pretty confident in. It's a spicy time, man. It all starts today. That's how I feel. It all starts today. We're not going to get a conclusion today, but it all starts today. Ooh, we got that grunge. We got the grunge beats, the grimy beats on. Boom, 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 boom. I don't even know if you can hear them. All right, we have 2 minutes and 30 seconds. Guys, this is your 2-minute, 30-second warning for Powell. The Powell speech. Go grab your drinks. Go take your cig breaks, whatever you got to do. Leave the stream open. Hit the like button, subscribe, join the Discord, you know, all the good stuff. We've got 2 minutes. This is your last warning, 2 minutes. Before we see Chirpow go live at Chirpow. And Gina, the beautiful, glorious, brilliant Gina, my love. 2 minutes. This is your 2-minute warning. Smoke them if you got them, boys. Oof. Gotta open the vent. Hey, don't blow that in my face. Don't blow that in my face. Son, this is the internets. All right. Follow me on Twitter. You got a little bit of time. Follow me on Twitter if you're not yet. And even if you don't follow me, please retweet or like today's Chirpow tweet. We only have 7 retweets. Like, just a handful of likes. Put that in the chat. Get it hype. Subscribe if you haven't subscribed. Like if you haven't liked. I think we have over 1,000 likes now. 1,200 likes. Guys, I believe this stream, especially if Chirpow gets spicy, if he says something crazy, I expect another 1,000 people to be here. This stream has the potential to break our channel's record. That's right. I think our record is in like the low 2Ks. I think once we had like 3K, but it was like all bots. There's nobody really here. We have mad real people here today. You're all real. Long it says Star Child. What's up, Jack Slacks? I like that name. What's up, Alpaca My Bag? Caspa. It was a 75 BPS. Chirpow speaks in like 1 minute now. William S. Daniel. Duke Boy. You started an OnlyFans to pay for gas. That's an entrepreneur. That's an entrepreneur. Support local businesses. We're about to tank below 20K. That's possible. Chirpow's coming on. You know how he does, man. Chirpow, he chirps. He chirps, man. Love you too, Faisal. Love you, bro. Or sis, I don't know. Can't tell by the name. Cryptos. Cassian is real. I believe you. Amazing view. Dude, Steve, it's a hype day. We've built these up, though. We've made like an event. Nobody watched the Fed meetings. And speaking of which, no one watched them. We made them popular. I love that you're all here. It's starting. Maybe it's not. I'm going to reload it just in case. There we go. Shh. Shh. Everyone shut up. Shush up, Nancy. Shush up. Shush up. Smash the like buttons. They're starting. There he is. Chirpow.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage points and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall, economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services.
He does seem to be like
a surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions.
Remember when it was all temporary?
FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
What?
We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Where's Gina? She's right there.
Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time.
Record viewers.
We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
Your second task.
Thank you, and I look forward to your questions.
Gina! I choose Gina first. Get up here,
Thank
stand
you.
up
Howard
here.
Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense you can of what role you played in reshaping market expectations so quickly on Monday?
I love you, Jerry.
So, as you know,
The dollar did not like that.
Always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve when they understand our objective function, our reaction function.
Yes.
And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual.
Oh yeah, Mr. Powell.
Again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did.
So we lied about it for a long time.
Made the decision.
Hey, Gina?
Shut up! Shut up! Gina's on. Shut up, everyone.
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Best question.
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action would lead to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So
dollar down. Did not
again,
see this
the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range. And that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward.
She's not even listening. She's like, I don't give a shit.
Just talking about the SEP for a second. What it really says is that committee participants widely would like to see policy at a
Do you see how he never answers a question? He's been blabbering on for like 30 minutes, barely answered the question.
Data, and so much can happen. So remember how highly uncertain this is.
Bitcoin almost
that is
trading green on the
generally
day.
a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much.
Or 200 weekly, right?
And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve.
Dollar bouncing right at the 200
Steve
weekly.
Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often.
Burn.
Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year.
We smashed the record.
Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate. Weekly? That affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how
bad. We said it'd get better. It got worse, but it'll get better soon.
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean,
next question.
Honestly,
Gina?
that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Gina?
Thank you,
Please, Gina. No one else, just Gina.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
That was a pretty good question.
So if you look at it, we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that
we
remain
get
the case.
2,000 likes, we get 1,500.
For most measures,
500
most of the time,
2600.
that's what you see.
Smash the like.
If we even see a couple of indicators that bring that into question. We take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up.
He's not saying
after
anything.
being pretty flat for a long time.
Gina?
So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say
question.
we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where
job.
I think as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Neil.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better.
Reminder, they've been
always a
anything but
trade-off,
transparent.
because you
They've
have to
walked
live
back
with that
everything
guidance.
they've said
And,
except for the schedule so far.
So you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done
Chairman
very
Crown.
little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that,
Inflation
then
can't go down
that's
if
the
it's
kind
going
of thing
up.
that will cause. Even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point, and we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data
progress in inflation going
late
up.
during
not our
blackout,
goal, but
pretty close, very close to our meeting. Very unusual to one that would actually change the outcome. So,
progress is progress. Next question.
I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come up a great deal.
Colby.
LTC, BTC, baby. It
Thank you
bounced
so
right
much
at
for
the
taking
200
our
weekly.
questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Shalom's totally right. This price action makes no sense to what's happening.
What we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, but and right now our policy rate is well below neutral, right? So soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw, and frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that our objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. You have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but.
Who is making more money? He said wages are going up. Anyone in here making more money? Like, who got a raise because of this inflation? No one.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation?
My new best friend.
Thank you.
So
some of
you're
us
right.
did.
In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs.
That's true.
But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic.
Answer in the poll if you are.
Where participation is high.
Or not.
Where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Bosa with Bloomberg.
Your mic sucks,
as
dude.
you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago, that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation, really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%. And it's largely due to commodities prices. But all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really. And by the way, headline inflation is important for expectations. The public's expectations. Why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become the environment has become more difficult, clearly, in the last 4 or 5 months, and hence the need for the policy actions that we took today, hence our resolution to, to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels. We see the economy slowing a bit, but still growth levels, healthy growth levels.
So then as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit, we're responsible for watching everything. But consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect. Really, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also, other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in, and we can't do much about the difference between the elements that make up headline that are not in core.
Sure, Powell.
Can I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Victoria.
Sure, Powell. Let's hear from Gina, please.
Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
You never do.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do, because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up.
None of the market's reaction has made any sense. The more hawkish interest rate, declaring more rates, stocks are up, crypto's up, dollar down, makes no sense.
We're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like, you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly, it's an incredibly unpopular thing, and it's very painful for people. So, I guess what I'm saying is the question, really critical question from the perspective of doing our job, is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris.
Gina?
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect to? Where do you see those going in the near future?
So, as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately,
I have.
Planes are very full and plane tickets are very expensive.
First real thing he said.
Some of that will be passed through of energy prices, but it's you're experiencing services inflation. Shelter inflation is high. So the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Recession does seem to be incoming. Markets don't seem to think inflation will be.
Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. That would be, I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective, and I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges. And again, the answer to the question, can we still do it? There's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
Greg.
Everyone has a question today. They're hot.
Thank you.
Hard
Greg
landing
from
for June.
Watch. Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So, as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the 2s probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So. Again, we'll be determined and resolved, but flexible.
Hey, Evan.
Oh my gosh, we got a ton of questions. Jesus.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public?
And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Of course they will.
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are, what extent are they going to be sustained? In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack. Although I think we have of course, a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And sorry, on QT, we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark Henry.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market, given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that was rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously. And so the demand was just suddenly much higher. And low, so we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's obviously we're watching that quite carefully. You would think over time. So there's a tremendous amount of supply in the housing market of unfinished homes, and as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels. So, thank you very much.
No more questions. Screw you guys. I'm out. Thank you, Chair Powell. What did we learn? 75 BPS today. We see markets actually trading inversely to what we would assume. The dollar moving up, actually, or the dollar moving down. My bad. Let's get rid of Gina. I love you, Gina. I love you. Bitcoin moving up back to the 200 weekly moving average on this speech. You can see down here is when Powell began speaking, and it basically has only moved up. On the NASDAQ, we got a green candle out of nowhere. S&P, same thing following suit. Markets are up, and inversely, the dollar is down. Not what we expected. You could say that's what you should have expected, but honestly, this is moving against what markets typically do. The strength of the dollar should be confirmed or strengthened more by these BPS hikes, and his speech saying, essentially the only thing he said in that entire time was, next month we're looking at a 50 to 75 point. So really didn't say anything new about next month, but didn't really put on the table 100 BPS increase, which may be on the table by the time we get there next month. Guys, we broke a concurrent viewer record today. We had 2,700 people at the peak. You guys rock. We almost got 2,000 likes. This was wild. I appreciate you all joining. If you didn't really know what was going on, you don't really understand what the Fed's doing, I can probably timestamp this, but at the start of the video, you can just go back to the start of the video, I went over what to expect, why they're doing it, what their options are, what problems they're looking to tackle, and how they're going to do that, and then also kind of a speculative timeline, and actually what actions they'll have to take to achieve those goals, and a timeline that actually matters. They're very far away from tackling inflation, despite what he might be saying. Interest rates are now, I want to say they're at like 1, 2. I was wrong earlier. I don't want to quote. I think at most they're 2%. I don't even think they're 2%. But anyway, they need to get interest rates close to the CPI, close to inflation, which is 8.6%. And that's based on this month's numbers. Next month may come out higher. That's a moving target. So they're very far away. At a 50 BPS a month, they are a year away. A year from getting there. Something tells me they're either going to have to get more hawkish, make bigger hikes, or make hikes faster. Quantitative tightening still even farther away, actually, than interest rates to inflation. Increased quantitative tightening, or they're going to have to walk this all back and say, we're going to tank the economy. There's really very little option in between. The dollar or the U.S. economy. Which will the Fed pick? We're going to find out month over month here. I hope next month we have as big of turnout as we did this month. This was freaking awesome, guys. I love you all. I love Gina. I love Chirpow. I don't love him, but I just love saying Chirpow. Here's what you should do. Smash the like and subscribe if you haven't subscribed yet. Jump in the Discord. We're going to do an airdrop here right after the live stream. The dollar's still dropping. Still dropping. Check out our sponsors, guys. Femex, Market Cipher. Femex is a great exchange. Market Cipher, you see me using it to make trades constantly. Both top tier in their industry. Shout out to them. Shout out to all of you that joined us today. I love you all. We'll be back July 15th. Feel free to tune into our live streams or TA, a little bit different content than today, but we're live here all the time. You guys are the best. I'll see you in Discord. I'm going to get that airdrop going, and I'll see you probably tomorrow. Crown out. I love you, Gina.